Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
In this episode, we will talk about stamps.com. This was one of the episodes that was suggested to us by one of our listeners. So we will talk about stamps.com in this episode. Hari, do you want to give us a quick disclaimer before we start?
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts and fundamental principles behind value investing. We are not your financial advisor. We don't know your specific financial situation, so please consult with the appropriate advisor before making any financial decisions.
Great. Before we start, just a few housekeeping items. We are going through the Value Investor checklist. At this point, a lot of people should know that we go through a checklist. If you guys don't have access to the checklist, please email us at info@valueinvestor.org. And if you guys would like an access to our Slack channel, that's where we communicate with each other about various topics. If you guys like access to that, also email us at info@valueinvestor.org. Awesome. So let's get started, Hari.
Yeah.
Stamps.com. First question. What does the company do?
So stamps.com is operates multiple businesses under the label of mailing and shipping solutions for the United States and Europe. Essentially, they operate under the labels stamps.com, Indicia, Metapack, Shipping Easy, and others. And essentially, their services focus on several different areas. So they talk about individuals and small businesses that are trying to ship mailers, letters and packages, and they allow them to essentially comparison shop for what would be the cheapest price for their particular shipping needs or weight, mailing amount, volume, etc. And they also provide technical services that allow, through their website and their APIs, to integrate with other services who are trying to find the cheapest price. They also do compete in kind of the Shopify, Amazon market, where they will handle shipping of your items and your goods. And they also have various things in between for medium-sized businesses and warehouses. And then the last aspect of their business is that they do this thing called customized postage, which they will print customized postage for if you're doing like a letter mailing campaign or something like that, and you want a very specific look to your logo or something on your postage, they will allow that or do that. So they operate in lots of different areas and under different business labels, but I think the business that people are most familiar with is probably stamps.com, because that's the original e-commerce business that they were in. Yeah.
So just a quick high-level summary. Do they operate out of just the U.S. or is it?
They are
do
also
they have global presence.
They are also in Europe, but they will ship to anywhere in the world through their carrier partners. So USPS, UPS, and FedEx all are partners with them. And then there are 350 different shipping partners that they integrate with. So not just the big ones, but even tiny ones that do regional kind of distribution and things like that.
So when you say partner with shipping companies, does that mean that, let's say I'm a retailer and I like to send a package to my clients, my users, via my direct-to-consumer online presence? Does that mean that I would buy stamps from stamps.com automatically through some sort of API, and then you would partner up with UPS to send packages? Is that how it works?
Yeah, I mean, there is multiple different ways that you can work with them. Some of it is, on an ad hoc basis. Some of it is you're paying a subscription fee, and then your subscription fee, as you use the service, gets, waived. if you use enough of their services, all the way to, they handled the entire shipping operations for, a medium-sized or distributor type business for e-commerce. So in essence, they're offering you comparison shopping and convenience for your package or your shipping and mailing needs. And they don't really differentiate between the two. It's mailing and shipping, all under the same service line. So, they have quite a few different ways that they can, you can work with them. And it's kind of just like, what works best for your business? And so in a lot of ways, they actually partner with and compete with U.S. Postal Service, UPS, and FedEx, because they're just going to pick whoever, that started with them. So
interesting. That makes sense. Just to ground us to the market cap. They are $3 billion.
Yeah,
time of this recording.
Yeah, $3 billion company, and the shipping business is enormous, as you can probably imagine. But they're not actually owning any trucks or doing anything related to that. They are just finding the carrier, so they're taking a cut of the fee that comes with the actual shipment.
Got it. Sounds good. All right, let's move on to the next question. Does the company have a competitive advantage? Describe them in the categories below. So let's start off with brand. Do they have any brand competitive advantage?
Yeah, I mean, I think if you've listened to podcasts or watched TV and stuff like that, you've probably seen ads for stamps.com. They do a lot of targeting towards small and medium-sized business as a platform to for them to integrate with your with them to basically use them as your standard shipping setup. So I think the brand part of that is pretty well known. If you're a small business owner, you've probably heard of stamps.com. The other services that they listed under their brands, I'm not in the business of actually doing any sort of shipping and logistics kind of work, so I have never heard of these other things like shipping, ShipStation, Shipping Easy, Ship Engine, ShipWorks. They really like the word ship, I guess. So stamps.com is the only one that I have heard of. But that doesn't mean that it is not, they aren't pretty common in the rest of the world, or in the rest of the U.S. And MetaPack is their Europe business that they just purchased last year. And so it operates out of the Europe market. And as far as I know, they didn't have much of a Europe presence before then.
I see. But would you say that brand is really one of their competitive advantage that allows them to continuously serve their customers and beat out the competition?
Well, I would say this, that as a layperson who doesn't have a lot of this need for this, stamps.com is the only company I can think of off the top of my head that actually does this kind of work. But that doesn't mean that if I were a small business owner, I would probably be more inclined to know more about this. So yeah, I'm not sure that brand is really the be all end all here.
Gotcha. Okay. Let's move on to the next one. Network effects. Does the company enjoy any network effects as competitive advantage?
I don't think so. I think that's a little bit difficult to, for those of you who are, new to the concept of network effects. It's the idea that I use stamps.com because other people are available on stamps.com. So there is some of that, that they've partnered with these 350 global carriers, global and regional carriers. And so if I use stamps.com because they have so many different carrier partners and options to ship something for me or to mail stuff for me. So there is some network effects, but I don't know. I mean, if I were a carrier or shipping partner, I would integrate with anybody who is willing to do it, right? Because that's how I get, I drive business to my platform. So I don't know that it's a huge, I mean, they're clearly benefits to both parties in this case. So I don't think the network effects necessarily is the winner here.
Okay. Let's move on to the next one. Switching costs. I think you kind of alluded to this in your answer there. You could talk more about this.
Yeah, so I mean, when we talk about the return on capital, which is where the moat actually matters, they actually have a very high return on capital employed, return on invested capital. They are, and so you kind of look at it and say, well, where is the moat here then, right? In order for them to have that high return on capital, it has to translate from somewhere, right? And I think, again, I'm not an expert in this area, and my hesitancy to with these questions is because of that. I think their switching cost is going to be fairly, significant here, because if you're an e-commerce business and you start your e-commerce shop and you integrate with stamps.com to handle your logistics, and you're using their API to find the cheapest carrier when somebody checks out, and then you present the shipping details to them. Stamps.com is a significant integration for that kind of business, right? I would assume that the same thing applies to a small business owner who's trying to sell, they're running their own Etsy shop or something like that, and they're selling, sending 15, 20 packages a week. They're going to want something like stamps.com to be able to help them. And same is true for somebody who's trying to do a physical mailer, campaign, things like that. They're going to offer, stamps.com is going to offer them a fairly significant, I think, advantage. And then it becomes a question of, they cite to their customers that, people don't go to the retail FedEx, Kinko's, they don't go to the U.S. Postal Service. If you're a busy small business owner, you don't have time to spend at the post office or at the, dropping off packages. So this allows them to do a lot of that work from home. They can print the label, pay for it, put it onto their box, and then either have somebody come and pick it up, or they drop it off at the store and then they're done. So it saves them a lot of time and effort. So I think convenience is a big part of this, in their model.
Yeah, definitely. So convenience, that kind of translates to, or directly translates to, switching cost. If it doesn't require a lot of energy for you to establish that kind of connection with stamps.com to do your business, then the activation energy to go with other stamps.com equivalent or competition is higher. The switching cost definitely does play a role here for sure.
Yeah, and I would say that also, if you're a small business owner, your account with U.S. Postal Service or UPS or FedEx you're not going to get the same level of discount that Stamps.com offers, because what Stamps.com does is they can also do what's called consolidated shipping. So they aggregate a bunch of orders together that are going to a common destination, and then they take it to a carrier. So you essentially can say, I need to send this to Cincinnati, Ohio, and they're going to package up a lot of things that are going to Cincinnati from Houston, and then go to the carrier and get a better rate, right? So they have some businesses that are, I think allow them to do economies of scale that you wouldn't get with just saying standard, account with the Postal Service or something like that.
I see. That's interesting. I think it's a nice segue into the next topic, or next category in the competitive advantage, which is low cost. And you're alluding to this right now, but I wonder how they actually make that work, because when we talk about economies of scale, like USPS or UPS or FedEx, they're as big as they can be. They probably do the same sort of optimization as what you're alluding to here at stamps.com. I wonder how they're getting that cost advantage.
Well, I think their big advantage there is the customer acquisition cost, right? They are taking on the customer acquisition cost so that Postal Service and UPS and FedEx don't have to do that. And so there is some benefit that they're providing there. And if they don't offer competitive rates, then Stamps will go to the next one. They'll go to FedEx, they'll go to DHL, they'll go to whoever, right? So, I think they have some, they have some play in the market, because obviously the Postal Service, UPS, and FedEx have a need to send all of these packages, and they need to acquire customers. And if Stamps can do it in such a way that it integrates directly with the API, right, with FedEx's API or UPS's API, and then they can print a label, then that's cheaper than UPS having to provide support and customer service and things like that directly with your small business owner and stuff like that. So I think there is some advantage there for switching and things like that. But the low cost aspect of it, to me, doesn't. They have an economies of scale. I'm not going to discount that. But I don't know that it's a low cost provider, because could somebody go in and integrate with these providers and provide the same service? I think so, but they really don't cite the cost aspect of it as the benefit. They cite the convenience aspect of it for a lot of their business. So they actually have a pretty nice passage in their 10K where they actually say why we are better than our competition, and then they actually cite the counter argument. They do the inversion for you and basically say why their competition is better than they are, right? And every one of the categories, it's we charge a convenience fee that our competitor may not, right? And so but the convenience fee is why they're valuable, right?
Yeah, it's interesting. And I guess the argument of customer acquisition cost might be lower, therefore it justifies UPS or FedEx to partner up with this guy. Stamps.com would make a lot of sense,
right,
from cost perspective.
Yep.
So let's move on to the fifth category, which is intangible assets. Is there any intangible assets that you can think of here?
I don't think so. I don't think they have any patents or anything that would make me say they have an advantage. The interesting part of this was their original deal. They had a deal in 2018. They had a special license that the U.S. Postal Service was giving to them that was kind of a subsidized rate that they couldn't offer anywhere else. And so because of that, Stamps.com was growing like weeds. And then they decided in 2018 that the Postal Service decided to end, this special deal that they gave to companies in 2018. And in 2019, December, they actually ended that, and the stock price just plummeted afterwards. So that special pricing that went away really took an axe to their bottom line. They lost a lot of operating efficiency on the operating income side, and it really they took the stock price took a haircut, and the revenue went from growing at like 25% a year to flat year over year. So and their expenses went way up. So we'll talk about that more when we hit finances.
Yeah. So I think that's illustrating of some of the dependencies we'll talk about: customer, supply, employee. That question towards the later part of this segment. But intangible assets, nothing that you can see there that's obvious. And so just to really quickly recap, competitive advantage wise, what we're really talking about here is switching costs and perhaps low switching cost, and then perhaps low cost, and then a little bit of brand.
Yep,
is how you would summarize it here.
Yeah, and I would say I'll add one more thing on the switching cost that I think I forgot to mention is that a lot of their e-commerce customers, they are managing the order the order for them, and so the order management, and inventory management and stuff like that. They're putting the packing slips, giving them packing slips to put into the package. They're doing end-to-end tracking of the package so that they can keep track of where it is. So that aspect of it, I think, is a pretty powerful thing, for the e-commerce side, that I think is where they're focusing a lot of their growth is trying to get those businesses up onto using that. And they also do a lot of I mean, it sounds kind of simple, but if you're doing a lot of package volume, just automating the forms that you need to get the postal service to pick up your package and to handle it and do all of that and get the tracking number and then sending an email to the customer to say this is the tracking number and things like that. That's a big part of their, that middleman workflow that they're providing. So I think if I had to, now that I'm talked enough about it, I think the strongest aspect of their business there is really that, there is a stickiness of their moat. Especially for these medium-sized businesses that are relying on them to manage the tracking and things like that.
Yeah. Okay, let's move on. I think we talked enough about the competitive advantage. Let's move on to the durability of them. Is there any risk to this competitive advantage that you talk about here? Switching cost, particularly to medium to small businesses. They're doing a lot of inventory management, not inventory management, but shipping management, some elements of fulfillment. They're handling that for small to medium-sized businesses, and you label that as the main competitive advantage. Is there any risk to this?
Yeah, I mean, I think the one of the things that they cite is that one of their competitors is Shopify and Amazon, and so if you think about running a store, and Shopify can basically do the same thing that they're offering. So there's competition there. Obviously, e-commerce last year was a $600 billion business. So there's a huge, swath of businesses there. But I think Shopify, Amazon, eBay, they are all kind of encroaching on that, kind of space. And I think it's nibbling on the edges, right? Stamps is not providing you the website. They're not providing you a lot of the other things. They're not providing marketing, traffic, anything like that, right? Which is what Amazon, eBay, Shopify provide, right? They're actually doing a lot more work for you. So, there's some, and some people don't want any of that stuff. And then there are a lot of e-commerce businesses that just start out that way, right? And then they move their presence to something bigger, and their own website and their own domain, things like that. So I don't know that I saw the biggest risk that they had was the Postal Service. If we were doing this exact same podcast 2 years ago, the Postal Service special deal that they had was the big risk. And then the risk actually happened, right? And their earnings took a big hit as a result of that. So, they have mentioned that there are no more future risks associated with the Postal Service. They're now just like any other carrier. Stamps.com is to the Postal Service. So they don't really get any special benefits with that. So really their response to that is that we now have much higher customer acquisition costs because we're not offering the cheapest price. They're not competing on price, they're competing on feature set. And so they have to do a lot more marketing, and they've amped up their marketing messaging in 2020. So I think the post USPS business is a lot less. The risk has already happened, and it's going to be interesting to see how how it affects their return on capital and things like that. And then not to mention that COVID is going to cause a significant recession here. I think there are some risks here. Because I think overall package volume may decrease as people spend less.
Yeah, it makes a lot of sense. I just want to kind of highlight a couple of things that you brought up or summarize, which is that, one, you have these full end-to-end platform plays that are happening out in the market that is eroding their business, namely Amazon, eBay, Shopify, etc. Shopify less so, but you got this full end-to-end platform where small businesses can go onto their platform and everything is taken care of them. They just need to focus on marketing, having a pretty pictures on the website, and then they'll take care of the inventory management and the fulfillment. So I think that is one thing that we want to highlight here. And then the second thing is, you mentioned COVID, just overall drop in volume, which is kind of a recent phenomenon. And then I guess the third thing here is really huge dependence on USPS deal. And that risk really did materialize and realized. So I would say, kind of, if I were to summarize what you just said, Hari, those three things seems to be pretty big risks facing this company right now. Okay, let's move on to the next question, which is, what are the company's long-term prospects and runway for growth? I think it nicely ties to what we just discussed in terms of risks, in terms of how the industry is moving. We talked about Amazon, talked about eBay, Shopify, all these different things. So how do you think about this question? Long-term prospects and runway for growth.
It's hard. It's hard for me to see the future with this business without a special deal from the Postal Service. They were not competing on price, and there are some people who, in some ways, the package delivery business is a commodity, right? It is a commodity that you are getting something from point A to point B. Obviously, UPS, FedEx, they all have some advantages that other companies don't, right? So I would say that there's definitely some risks here, and I've kind of struggled to kind of see what the future holds for this business, right? I look at it, I look at what they think are projections that actually didn't come out from. They came out in their proxy statement because they were talking about what the compensation would look like based on certain revenue targets that were essentially flat for the company. So I find it, to be honest with you, I'm kind of struggling with this, and this may be because of just my lack of, I'm not an e-commerce person, right? I don't know a whole lot about e-commerce, and I struggle with that part of it. So the only thing that I can really say about this at this point is, I think that they're going to spend a lot of money on customer acquisition, so sales, marketing, expertise. They're going to try and make more deals with more carriers to kind of expand the pipeline of services that they offer. But I don't know how that's going to translate into future revenue, right? Their growth was essentially flat after they lost the Postal Service deal, and they had much higher costs. So it's going to be, they're going to be more of a commodity business going forward. With that being said, they're very asset light. They have a very high return on capital. Even after this, they've taken a hit here.
Yeah, so let's talk about that, actually, which is a nice segue into our next question. Does the company require a lot of capital reinvestment to maintain its business? Can it grow without any further reinvestment? So you talked about capital light business, and usually capital light business doesn't really require a lot of capital reinvestment. Can you add some more color to this question?
Yeah, so to give you an idea of where this looks, most of their assets are actually in cash and goodwill. They have about $900 million in total assets, 385 of which is goodwill. So, and that was due to they've had a lot of acquisitions over the years. So when we start looking at their return on capital, the capital employed in their business is they're basically a tech company, right? They're not offering any, there's no per shipment cost for them to deal with anything. It's essentially just they collect a fee off of this. So they're, in some ways a toll bridge, but the problem is they don't have a monopoly on the toll. So it's not a true toll in that sense. You just use them as an avenue to make your package or mailer go out. So, they are an asset light business. They have a high, return on capital, and they don't require a lot to maintain that, that aspect of their business.
Yeah. Makes sense. Very much a tech company. I mean, $300 million in goodwill is something we would have to definitely talk about in the next episode when we talk about financials. But answering this question, it seems like a resounding resounding no, that they don't require a lot of capital reinvestment to maintain its business, just like any other tech companies
Yep.
out there. Okay, great. Let's move on to the next question. Does the business have favorable relationships with the following? And I'll just list them out right now: customers, suppliers, employees, regulators, community. Is there any red flags? Are there any red flags that you see with any of these relationships?
No, I mean, I think that, like I said before, the risk that they had with the Postal Service's special deal, the Postal Service's deal went away. And so now there isn't much of a risk there. I don't know that UPS or FedEx would ever exclude them, in any way, because, like I said before, it's an acquisition thing. So, they've mentioned that no customer represents more than 10% of their business, and so I don't think there's any risk of a single large customer leaving. And like any tech company, there's do you lose some of the do your employees kind of matter there, that any one employee could affect it, and I don't really see that either. So there's not a lot of risks in that regard, but I do think that there's some risks that we need to be, that this was a business that had a special deal. That deal has gone away, and I just don't have enough information to see how they're going to respond going forward. So
I see. Okay, great. Thanks for covering that, Hari. So just to wrap up kind of this episode, I think we talked extensively about the business itself and the competitive advantage, and with asterisks and caveats that Hari and myself are not in the business of small business, delivering goods and e-commerce and things like that. But at least on the surface, it sounds like this business has been able to grow by exploiting their switching cost moat, and then to some extent low cost and brand moat.
Yep.
And they were able to turn that into high return on capital, which we'll talk about in the next episode. But no red flags in terms of customer, suppliers, employees, regulators, and then kind of a question mark in terms of the prospects for a runway.
Yeah.
Awesome. Okay, we'll close out this episode here, and hope you guys join us for the next one.
Oh, thanks.